Welcome to the Corporate Venturing Insider Series, where I interview top practitioners in the CVC world and learn with you the best practices and golden nuggets that they have accumulated over their career. In this episode, we will be learning from Aaron Brandt, Executive Vice President at Hypertherm Ventures. Aaron, could you take a few minutes to share your story and how you got to where you are today?
Sure. Thanks, Nicola. And hello, everyone. Really happy to spend this time with you. So to back up a little bit, I've been with Hypertherm for over 20 years, which is quite a long time to stay with any one company. My journey really started with my graduate work, where I was doing research on laser cutting at Penn State University and working on a project there, and then networking and connected to start my career as an R&D engineer at Hypertherm. And did that for quite a few years, really designing plasma cutting products. And so as I advanced and as the company grew, and moved into areas of engineering leadership, so leading large projects and large new R&D technology efforts, and then ultimately into general management. So I managed our largest heavy industrial plasma business for about 5-6 years, which was a great team to work with. The way we work at Hypertherm, our business units are really standalone companies with engineering, marketing, and operations all co-located working on a common customer segment. And so those were some great times. What's always driven my passion throughout my career is that intersection of technology, business opportunity, and people, and how their needs can be further met and how you can build successful business models around that. And so my whole goal as head of technology is to help build that within our business units, but also to expand our reach into other areas. And then just in the last 2 to 3 years, getting going on setting up our corporate venture capital group, assembling the team, finding the partners, and starting that journey. And so maybe to build on that a little bit, tell a little bit about Hypertherm's journey, and then how that kind of then connects with my career now, where we're trying to go with venture capital. Hypertherm was founded 50 years ago in a garage. So we've got the common founder's story of just an engineer working on an exciting technology that they were hoping to bring to market. So going on the rocket ride of global growth with everyone else, where we really built over time a very dominant position in our market, which at the time was heavily focused on plasma cutting equipment. So today, at this point, we're still the global market leader in plasma cutting worldwide, both for heavy industrial equipment, robotics, and automation, as well as handheld equipment.
Very nice. Thank you, Aaron. My question is your engineering background as part of a CVC useful beyond just the due diligence of the companies?
Yeah, absolutely. I think that for most startup, when we talk about whether it's a startup or a new business opportunity, there's a couple of things that have to connect. And I really like the IDEO model here of human-centered design to describe it, which is there's got to be some sort of novel value in technology. There's got to be a need, a human-centered need for it. And there's got to be a way to craft a successful business out of it. So I think a lot of others define innovation as something that's novel, something that's useful, and something that's successful. You need all three. So the technology background that I bring, and so my degrees are in mechanical engineering, and then I don't have an MBA, but I built out my business experience over time with some, as I was moving to general management, taking the marketing course at Kellogg, or because we're in New England, going to MIT for some exec education on technology-driven business models.
Very nice. And I did not know you lived in Asia. So I lived 12 years in Asia. So maybe that's a discussion for another time. How much of your investments are just looking at the US versus completely globally? Because innovations could happen anywhere in the world.
Yeah, starting out for us, we made the conscious decision to stay somewhat close to home, a little easier to do the diligence, to do the research. We've looked at companies in Asia, in Africa, actually, that are in our target areas of interest. So we're open relative geographically, but certainly with a more dominant North American mindset, at least for the first couple of years as the team gets momentum and capability and experience.
Very nice. And part of this, I like to call it building the muscle and then building the reflexes. So maybe this is one of the golden nuggets, which is really about take your time and start small, and then you can always grow, but you need to get the best practices first. So can you explain how you intended to add value to the portfolio companies and how in practice you see this value added?
We really consider ourselves kind of pioneers and scouts to find emerging technology, and really working with someone that's trying to make a business of it. You learn so much more than just maybe subscribing to a report or getting industry information back. We also hope to identify areas where ecosystems can be created that our businesses can benefit from. So if someone is creating a capability within a new space, if someone's bringing machine learning to industrial applications in a way that's going to really benefit our products, we want our businesses partner with them. And so that's a great way for our businesses to learn. And then the final piece of bringing all that back to your original question, which was what value can we drive? With every investment we've done to date, what we really try and do from day one is sit down and say, just like a job interview, you need to be right for us, we need to be right for you, and really try and document down what are your expectations.
Can you walk me through the mindset and what type of questions and answers you have for what your portfolio should look like in 5 years?
Yeah, so it's a great question. And a couple of the conversations, and we're still forming this a little bit too, in full disclosure, a couple of the ways we've thought about this, obviously we've got our 4 to 5 areas of interest. And it's a little bit about how do we want those weighted, thinking about where we can have impact. And a lot of that's where we direct our team to focus their research and say, all right, where do I want your spread of time spent today, knowing that's likely going to reflect an outcome. And also what's happening in industry right now, where's a lot of the money flowing, where startups really having traction and build. And in general, we've positioned a lot of the portfolio to be further away from home. So we've weighted more heavily to digital solutions for that reason, because that's an area where peak learning is required. Another area of focus was where are the areas of potential maximum disruption to core business? And for any metal focused company where we've been with plasma, Waterjet being much more diverse, metal additive manufacturing shows up loud and clear as potential disruptor over the next 10 years. And so our very first investment was in a metal additive company in San Francisco. So it's been really with the lens of target area, as opposed to trying to blend across seed, series A, B, or size of investment. We're letting those come as they may. Our typical check rates are going to be between 500K to 2 million, max of 3 for an initial check. So we're already going to be somewhat balanced portfolio there anyway. So it's been mostly about spaces.
So one of my questions, which could be really practical, but maybe useful for others in the audience, is when you make the investment proposal, how do you document what type of learnings you are expecting to get? And do you plan to track that you're getting the learnings you were expecting?
Yeah, the answer to that is an emphatic yes and yes. And I think any good board will hold you well accountable, certainly to the financial governance, but as well as are you getting total value? That the average new VC fund takes 7 years to show financial value, and the average life of a CVC is 4 to 5 years, which means you better be demonstrating value as you go. So you're getting additional license to operate by your management, by your board. And so for us, those early ones are so critical. An example of that for us, we did an investment in the summer in a great company called Ready Robotics, and they're located in Columbus, Ohio. And they're doing some really interesting work on the future of essentially the control system for a robot, which, if not to go too deeply into this, but the 8, 10 plus robot manufacturers all have their own interface systems, their own software. And so if you're a company that's trying to figure that out, or you're someone who's trying to learn how to operate robots, that's a real struggle. So they've created a unified operating system to make it super easy to learn, super easy to run any type of robot without any programming capability. Really great stuff. We have a robotic software company in our company portfolio in Montreal that does offline programming. These guys are doing the online, so very synergistic for us as well. We can help them. One of the early wins for us was getting them to come on site, not easy in a pandemic, but to meet with operations, to think about some learning opportunities that we could drive. We're on an automation journey within our own 4 walls. So really having those deep conversations between the startup, between our operations leadership, talking about projects they can be working on. They're continuing to work well together. We've documented that. And so we're developing, it was right on the initial investment thesis. Can we demonstrate it quickly? Can we show it?
Very nice. And maybe we'll double click on the investment memo. How collaborative is that writing of the investment memo with other business parts of your company? Do you get a lot of inputs? Do you collaborate, or is that something you prefer to do it separate?
Hypertherm, because we're fairly egalitarian, it's all consensus collaboration driven. That's a key part of our culture, and we're no different here. So the way the investment memo is driven, so our director, Nathan Pasquarella, really takes the lead on that with his team. We have our advanced development team, which is the group of kind of senior scientists and engineers that are doing internal incubation. That's a huge advantage in that for the technology lens write-up, they will take the lead on that for us, and they'll dive deep into the tech and really give an overall assessment of, hey, here's our perspective on the technology.
Very nice. Now, I want to challenge you on the word consensus, because in VCs, it's known that if you want to do exceptional returns, you need to invest where people disagree. It's a good investment. You invest where everyone else disagrees. Is there a risk where you try to get too much consensus, you end up actually going for the safe bet, which probably means you overpay because everyone wants to invest? So
Right.
how do you take this consensus mindset, which is a good mindset, but into an investment as a VC with a financial mindset you mentioned earlier?
Yeah, it's probably worth a bit of definition, right? So from my perspective on consensus, it doesn't mean 100% agreement, but it does mean that 100% of the views have been heard and internalized, reflected on, and then a decision is made. And so it's more about just being open to information, to exploring, and then coming up with a rationale that should be able to survive vigorous questioning. And it's okay if we disagree. And this is true for how we run our internal business as well as investment decisions. It's fine if we have different points of view and we disagree on it, but at least it helps crisp up your hypothesis. So with any thesis that you've developed, there will be naysayers, there will be a negative viewpoint on that, and that's great. That means that there's a near-in learning objective that you may want to prioritize.
There's one thing which I find interesting is that you started incubation much earlier than you started the corporate VC. Can you tell me about how you've done incubation and whether the way you do incubation now is slightly different because of your CVC inputs?
Yeah, no, it's a great question. And it has evolved a little bit because often when you only have the internal group, it has to take outsized responsibility for what you really can do solely within your own four walls. And people tend to be a little more closed up off from partnership. So our incubation group was founded some years back when we, in the late 90s, early 2000s, started to assemble into discrete business units. And what's great about business units is that we really love that co-located marketing, ops, engineering, solely focused on a customer segment. It's a way to stay nimble in a large company organization. But what you can miss out on are the interconnections between businesses, technologies that don't have a direct home in a business unit's charter tend to get lost or tend to not get funded. And so our advanced development group was started up to really meet that need and find the right balance of senior scientists, of discrete capabilities, of staff. And the project list that we had them work on, in some cases, were new business potential incubation. So looking at taking technologies at a business segment, putting a marketing person on it with them, a business development person, creating it, as well as first principles research as well to explore areas of advanced R&D that would be interesting for us. Getting into external partnership made sense in a lot of ways. As part of our company ownership ethos, we also have a no layoff philosophy. So we've never had a layoff in 50 years. People are not disposable assets. And so that we don't pull that trigger ever. We'll cut back in other ways. So that means every hire is precious. So staffing up a large group to go after a niche technology doesn't make sense because there's high failure rates there. And so what's happened now is we can create a strong community of generalists that are built out with some specializations where we know we're going to need it, and then really have developing our partnership chops with the CVC, really broadening people's thinking that other people are doing great work in these spaces. And we've seen that's created additional mindset internally where a team of technologists where maybe they would have said, no, I can do this myself. They're saying, can I find a partner and do this faster? Why do all this work myself when I can make it even better and stronger with others? And so it's had this kind of halo effect on what we do because we're constantly bringing in other external groups that are doing great work. And so, yeah, so it's shifted in that they don't have to carry that full burden. They can help more with development that's going to directly impact the business and not feel that all the scouting is solely falls into their responsibility and accountability.
Very nice. Let's move on to the investment decision making, because I think that's something I'm sure you spend a lot of time thinking about how to get it right. Can you describe how you're making an investment proposal, the size of your investment committee, how they vote, how quickly they do it, and do you need one approval or two approvals?
Yeah, we have a couple of stages to the process here. And what we found has worked best for us so far has been, maybe I'll break this down. It starts not just based on the individual investment, but in mapping of the space. And so because we'll have the investment team that is fully immersed and they're really into it and deep. And then the last thing you want to do, and we know this now because we've made the mistake, is come in and you're going to do a 45-minute meeting with the investment committee and you're going to cover the space, this whittling down of 50 or 100 companies that you've looked at, and here's this great one, and we want to make X investment for X percentage. And it's just too much information for them to take in. And what we found happens, and I think this is a natural human condition as well, is if you haven't been on the journey, there's a lot of unanswered questions that are along with that. And it's not a question of trust. It's just that when you're dealing with top executive professionals, they have a lot of curiosity. They've got a lot of knowledge. They want to know if they're voting, they're all in on a decision. And I think there's also a little kind of fear of missing out if you're only seeing the one great one, as opposed to at least some exposure to the sifting that's occurred. So the way we've tried to break it down now is if we're really mapping an area, we'll give at least a monthly update on, we're mapping the space. Here's what the overall portfolio looks like. Here's the number of companies. Here's some of the insights we've developed so far looking at it. And here's the 2 or 3 front runners with a single slide type summary information on what they're about, team, technology, market, what's unique about them, what are the questions that we need to explore. And so that gives the investment committee time to look, to digest, to offer some questions back, which we can then incorporate in the further sifting and refining. After we've done that, as we're looking at the top 2 or 3 and really cultivating that relationship, we're building that more detailed investment memo, trying to get that to the team, even if it's in somewhat of a draft form, calling out where we have strong thesis developed, where we're still trying to learn. We only need one investment committee meeting on the investment decision. So we'll say a quick reminder, here's the mapping of the space, what we've educated you on. Here's the top 3 or 4. Here's why this one is the best one. And it's usually a combination of they're really strong and it's just the timing, because we don't, and that's also an education for your internal management and board, is that you don't control the timing. When they're doing the B round, they're doing the B round, and you're either on or you're off. And you have to be prepared to make those decisions sometimes quite rapidly. And we're still building that kind of body of knowledge, but I think it'll be really helpful and powerful to have those overall spaces mapped, some high level thesis around what's happening in the startup community here. So that way we've got a common grounding when we're looking at the one, and the entire team has the context and we're not having to recreate the context every time.
I think it's really good to take the investment committee, and I'm assuming probably more people than the investment committee along this journey. Can you tell me more about who gets access to this really good context setting information, but also the size of your investment committee and how they approve or not approve? And do they need the majority? Is it everyone needs to approve? All these design aspects that I think many people in the audience would want to learn how you do it.
Yeah, so our investment committee is quite small. It's 4 others in addition to myself. It's the CEO and CFO, as I called out. There's our head of corporate development, who is both acquisitions, but has also run major businesses with other companies like Eaton. So he's got a great point of view. And then finally, our VP of People, Community, and Environment, Jenny Levy. She really brings both a strong business mindset. She's an MBA, has run industrial manufacturing operations, but also has really headed up our corporate social responsibility and people objectives over the last few years. And so that helps keep the team well balanced around business, finances, and people. And so we've really constructed it that way. We'll also, as often as we can, socialize with the full management team. So if the meetings coincide with when we're having a monthly executive management meeting, we'll hold the investment committee meeting with that broader audience. So the VP, heads of business, of operations, can also be there and offering their viewpoint, and certainly all the materials, we socialize with them as well. So that's a predominant group. And then we'll give quarterly updates to board on key governance, pipeline, how things are progressing, top updates on our investments, where the overall portfolio is going as well. We've had good consensus in terms of everyone's voted yes on every investment to date. So we haven't had a situation where it's been a majority rules. One investment that we walked away from was a mixed discussion where we had some that were really seeing it and others that had concerns about fit with Hype. It still felt good financially, but not the best fit. And we walked through that, and we all decided, no, we don't have enough here to really move forward. So it's a very congenial group, and they're very comfortable making decisions without fully complete information, which I think you have to be anyway.
At the beginning of the interview, you talked about how you need to change the mindset of your management for thinking the right way about corporate VC. And maybe I'm not putting exactly the right words, but I think the mindset is really important. How do you feel about, now that you're in the journey and you've done all this context setting information, you've made your first few investments, how much of that is helping your company be ready for the next disruption, embracing the disruption?
Yeah, it's a great question. I feel like one I'll be more prepared to answer in about 3 more years. But at the same time, I feel really good about the way people are already talking about additive manufacturing in a different way because of what we've learned. And it's not just in the company we invested, which we're really proud of. And that company's Mantle, by the way, I'll give them a quick shout out. But very excited about the work that they're doing. I think really introducing to people what it takes for a team, strong business leadership, which they have, strong technology and passion, fully focused and dedicated. A lot of people that have joined our company weren't here when we were founded, obviously. And so that founder's journey, that startup journey, the excitement, the hard work, the blood, sweat, and tears required to do, that's a huge exposure that's brought. The mapping of the additive manufacturing space, not only on the great work they're doing and why that can be a winning formula, but also everything everyone else in the ecosystem is doing that we've looked at, that we've tried to understand, that we've brought back. That's just created a different level of intelligence than we would have ever had, and given us comfort in areas of our business where we say, you know what, I was worried about this, I'm not anymore, because actually there's a lot more synergies here and opportunity than there is kind of risk and threat and disruption. And areas where we say we're going to have to watch this closely over the next few years and incorporate that into our business plans and think about how that will shape our future journey. So on the robotics side, I mentioned Ready, and there's some really solid work with understanding as we're looking at cutting applications with robotics, which are growing and growing. But how do you make that successful, and how do you build integrator networks, and how do you help manufacturers go faster with robotic automation? That's playing huge dividends in the business's strategy. And then our third investment to date, which is a small startup known as Synthicos, focused on something fairly close to home with us that's disruptive to water jet cutting. There, it's really been about watching this team try to develop this new technology, figure out the right way to bring it to market, and helping the overall water jet organization understand that context. So far, I feel really good about the learnings that have happened, and I feel like that's just going to continue to compound. And if we can help the company understand these spaces better, if we can help people know how to partner better, learn how to build businesses by watching it happen, and drive strong financial return, that would be huge to look back on. Nothing would please me more.
I think it's a very inspiring answer. One is because it touched on the why you started in the first place, but two, you're very concrete about what could be success stories inside your company on why you did it, and you already can see it's bringing learnings. I like the word compound, because also I think all these learnings compound with each other. They build on top of each other. In TPK Ventures, we call them knowledge graph, because all these self-contained units of learning start to connect with each other and becomes a knowledge graph. So I think it's a really inspiring way of ending the interview, but I want to ask one final question, which is, if you were to give an advice to Aaron 2 years ago that you wish you had, what would it be?
Ultimately, I feel good that we ended up where we did, but the advice would be find really good partners, ask as many questions as you can, connect with as many people as you can. This community, venture capital, is so open, so helpful, so understanding, because like you said, it's very high risk. And so the way we find the best opportunities and put ourselves in the best success is we collaborate, we communicate, we help each other and give back. So I think really trusting that would be number one. Double down, triple down on the networking and asking questions before you consider even talking to a startup about a term sheet. And if I could have delayed that first term sheet conversation by another 6 months to give myself more time to learn, I still feel very good about where we ended up. But I think the learning would have been easier for both myself as well as those early founders if we had educated our group more. So it's worth taking that extra time and giving yourself room to learn before you try and dive in.
I think that's perfect way of ending the interview with a final golden nugget. Very inspiring. Thank you, Aaron. You were very candid, open, and you shared so much.
My pleasure. Really enjoyed the time. And I've been inspired by the TDK Ventures journey as well. I feel like we've been fortunate to be just a bit behind you on our growth, so we can watch everything that you do. And I'm just so amazed and impressed with everything you've built so far. So congratulations to you as well. And thanks so much for this time.
Thank you, Aaron. Bye.
Bye-bye.